current crisis in the Eurozone has been explained by two broad views. The first viewpoint is due to various Attinasi, Azeimane, and Amisano, and according to this view, the main drivers of the current crisis are prospective budget deficits and default risk in the European periphery. The second point of view de-emphasized the role of fundamentals, so budget deficits and default risk, and focuses on contagion and fears of a euro breakup. This second point of view can be found in models developed by Argyrol and Sokalas. In particular, they developed a model around Obstfeld and Krugman setups in order to explain the current euro crisis. It is our framework in which we consider the European Monetary Union as an hard peg system, and our interpretation is that spreads reflect both default risk, but in particular reflects currency risk. De Grauw, in particular, proposed a theory of fragility of monetary union in which markets or countries are exposed to self-fulfilling liquidity crisis and speculative attacks due to the absence of a lender of last resort. Bolton and Jean developed a model of contagion through a banking system in financially but not fiscally integrated unions. We, in this theory, in this approach, we can find also our first paper with Giancarlo Marini and Giovanni Versanti, in which we develop an index consistent with second generation approach to currency crisis to assess the vulnerability or the incentive that countries belonging to monetary union have to live, leaving the monetary union. The issue of a systemic risk in the European Monetary Union has been analyzed in many recent papers, in particular Eichler using data from the ADR stock market, the American Depository Receipts market, have assessed the risk that some vulnerable countries might leave the Union and reintroducing the old currency. Hui and Chung and other authors use the US dollar euro currency option to estimate the euro's crash probability. during the sovereign debt crisis 2009-2010. Di Cesare, okay, Di Cesare and other authors take as an indicator or build an indicator of risk of euro breakup using the Google-based indicator, taking account of the numbers or the keywords euro breakup in Google. Finally, Close and Weigert show that interest rate spreads in the euro area are correlated with the expectation of euro breakdown using the intratrade platform. From this platform, they derive the probability of a euro breakup. But these papers are not at country level in the European Monetary Union. In particular, they consider the risk assessing the euro area as a whole, and we use our model in order to assess the probability that each country belonging to the monetary union chooses to leave the monetary union. So our discussion is organized in two main sections. In particular, the first one is the fact and literature reviews, and then we consider our empirical analysis in which we try to explain the current increase in risk premia in the euro area using our indicator of euro breakup.